From our studio in New York City, I'm Julie Hyman. That's Josh Lipton. This is Yahoo Finance Live, and here's what we're watching this afternoon. A make or break moment for the market. It's here as we wait for big tech to report earnings. In just about an hour, we'll hear from two of the Magnificent Seven, Microsoft and Alphabet.
And ahead of the results, the major averages mixed here. It's already been a busy day for earnings, but the signals from corporate America are also uneven. We're taking a closer look at what companies outside of the Magnificent Seven are saying about the economy.
Plus, an exclusive interview with Pfizer CEO Albert Bourla, the pharma giant, reporting earnings this morning. And it comes as the company has struggled in a post-COVID world and faces a slew of challenges, including patent cliffs and Medicare price negotiations. Let's get you up to speed on the market action here as we wait for yet more earnings after a lot of earnings that we have had already. So if you check on the three major averages in today's session, we are seeing a mixed picture here. The Nasdaq right now down about 2/3 of 1%. The S&P little changed. The Dow up by 136. Now remember, if we get any gain for the S&P today, it's another record close. If we get any gain for the Dow today, it's another record close. Ditto goes for the Nasdaq 100, if not the composite. So we are seeing a little bit of an upward bias here today, but obviously a lot of focus on individual companies that have reported and a lot of anticipation for the earnings yet to come. We also got some economic data this morning that came in and showed there is still strength in the economy. JOLTS, for example, job openings coming in higher than estimated, Josh.
Yeah, and you know what I think we do, Julie? Why don't we start by looking at some earnings today?
Let's do it.
Because it is just interesting what this morning was being reported and said in investor reactions. I'm going to highlight two names for you. Okay. All right, UPS, swing and a miss.
Yeah,
swing and a miss. Interesting puts and takes there in terms of, and you can see there we're down more than 7%. Just package demand, labor costs, job cuts, the company cutting 12,000 workers, the commentary, the company, you're talking about 2023, difficult, disappointing. So you say, okay, that seems pretty doom and gloom. But then here comes GM, right, with a very different, so they report, they beat, the stock is higher in today's trade, and some very positive commentary from GM. You see they're up about 8%. Specifically, CEO Mary Barra is saying consensus is growing that the U.S. economy, the job market, and auto sales will continue to be resilient. That's how she put it in a letter to shareholders. So it's just interesting as we work our way through peak earnings season here for investors. You see these reports and you're just trying to make sense of where the economy's at and where the consumer's at.
Good luck, I think, is the takeaway, right? Tony Dwyer over at Canaccord Genuity put out a note to his clients earlier in the week when he said, if you're looking for guidance this week from a very busy week of corporate earnings, of economic data, and the Federal Reserve's meeting, you're not necessarily going to get it. It's a very difficult picture right now. And if you're trying to bet on a direction for the markets, maybe this week is not going to provide you the clarity that you seek. And these two companies are sort of emblematic of that. Yes, they have some idiosyncratic stuff going on, particularly when you look at GM and the sort of costs it has incurred for its electric vehicle business, its cruise business as well. But nonetheless, they still do reflect a certain amount of what's going on in the economy. And they're saying two different things. And they're not the only companies that are saying different things. As you pointed out, there's the example of a company like Whirlpool, which also talked about weakening spending. Yeah,
and Whirlpool is so interesting because when you see a report like that and a reaction like that, and there you go, we're down more than 60% right now, you begin to get, you can get concerned about the consumer and their confidence and, wow, do my friends and neighbors not want to buy big ticket, items, not want to buy appliances? But on the other hand, and listen, I don't want to throw too many tickers into the conversation, it can get confusing, but then you would look at a Visa, right? We report those earnings, and what did Visa have to say? They talked about a consumer that was resilient.
They used that word resilient
that was their word.
Again.
So,
yes, we've seen that word thrown around quite a lot. So yes, bottom line is if you're going to look through the prism of these earnings, it is still confusing. And even if you look at some of the economic data, which is showing some strength, are we going to get some guidance from the Federal Reserve tomorrow as to the pace, the timing of cuts? That's what the market's looking for. We'll see if they're actually going to get it.
And after the bell today, listen, we've got big names reporting. Maybe that gives us, at least some more clues and things to talk about.
Maybe some clues, but also it feels in some ways like there's the the companies we've been talking about, and then there's the AI everything, which sort of is existing on a little bit of a parallel but separate track right now. So it's unclear if that stuff is really reflecting economic fundamentals at all, or is sort of divorced from them.
Good question.
I don't know, still lots of questions. All right, the Federal Reserve is expected to leave interest rates unchanged at its meeting this week. Investors will be looking for any hints at when the first rate cut of the year will come. Our first guest today says that Jay Powell and company are in no rush to cut. Joanne Bianco, BondBlock's partner, investment strategist, and client portfolio manager, is joining us now. And Joanne, you know, as we've been talking about, yes, the earnings are sort of painting a confused economic picture. The data that we've been getting has been relatively strong. So if the Federal Reserve is trying to make the case for cuts this year, how does it do that in the face of strong data?
I think it does that if it really does feel like inflation, will continue its downward trajectory to get down to its 2% target. We've been very happy to see how resilient the U.S. economy has been, because as that relates to corporate credit, where we have a lot of ETFs that we manage that focus on areas of the corporate bond market, both investment grade and high yield. So the resilient fundamentals that we're seeing in the resilient economy is good for corporate credit, and it's a reason why it's an area that we're still very constructive on.
I'm interested, Joanne, though, when you think about the Fed and how exactly rate cuts, I'm just interested to get your take. When you think the first rate cuts come, Joanne, how deep they're going to be? And does it matter to you, Joanne, when they come, if it's first half or second half?
Right. Yeah. Well, I think that we were never in the camp that we thought that they were going to come as early as March. We thought it would be something that would be probably in the second half of the year, where we would start seeing rate cuts. I mean, it doesn't seem like there is a strong reason for the Fed to rush rate cuts right now, with how strong the labor market has been, how strong the economy continues to be. They're not at their 2% target for inflation. So, the fact that the market's been recalibrating in terms of its optimism about the number of rate cuts and the timing is something that doesn't surprise us.
Joanne, how much do you think the Fed is going to, meantime, use its quantitative tightening tool, its shrinking the balance sheet tool, which has not gotten as much attention here, but is that something where we're going to see the Fed be pretty assertive?
I think, I don't know if assertive is going to be the word there. It's something they probably, continue to focus on, but do they do anything dramatic there? No. I mean, not without telegraphing it to the market first.
I mentioned Joanne, too, tomorrow when Jay Powell at that presser, what do you think he's going to say, Joanne? How does he kind of walk the tightrope here? I'm sure he's happy about the data he's seeing. He also doesn't want to, trigger another, financial markets rally like we saw in December.
Mm-hmm. I think, if I were to guess, I would say that they would telegraph that we have some time to continue to develop to see what the data is saying and what their next action will be. But I don't think they're going to be indicating any real rush.
So, Joanne, given all of this, what do you do from a strategic perspective right now?
Yeah, well, we think that, our base case view is that the economy will continue to demonstrate a lot of resilience. We're not forecasting a recession at any time during this year. So as a result of that, for fixed income, we think that investors are well served by looking beyond broad-based benchmarks to generate attractive performance this year, and that they should invest in more precise exposures, specifically exposures that benefit from a still resilient economic outlook. So towards that end, we're especially constructive on BBB corporates and also high yield corporates. High yield, as you know, was the best performing asset class last year. I think it was something that was definitely our top pick for last year. It's also our top pick again this year. And I think the market was surprised by how strong high yield did, thinking that the economy was going to go into a recession last year, but that wasn't our base case then either. So We saw high yield strong, even in the lowest rating category, rated CCC. It was up over 20% last year, and it's still yielding over 12.5% this year.
So Joanne, I'll get you on this. That's what you like. What don't you like, Joanne, in the credit sector? Where don't you see value right here?
Well, I don't think that there's a reason why you have to be up in credit quality in the U.S. corporate sector or in investment grade. So I think that, triple Bs are the best area to be in U.S. corporate credit. They are an area that could outperform not only the rest of the corporate bond market, but also the U.S. aggregate. So I see no reason to be overly conservative in your positioning this year.
Joanne, thank you so much for your time and your insight today. We appreciate it.
Thank you.
Let's check in on some trending tickers here. We're going to start with PayPal rising higher as the company, well, now we're ticking lower by about 0.2%. Headlines, that's going to reduce its workforce by about 9% this year as Chief Executive Officer Alex Chriss looks to cut costs and improve profits. So that's the headline we're seeing here. Julie, PayPal will reduce its workforce by about 9%. In a letter to staff on Tuesday, this per Bloomberg, Chris saying the decision was made to right-size the company. Affected staff apparently going to be notified by the end of the week. We saw a similar round of cuts last year in this time, last January, and move, it sounds, is going to affect about 2,500 workers.
Yeah, and we've been talking a lot about cuts recently, haven't we? You said the shares rose because they did rise initially after this headline came out, and then they kind of dipped back down again, maybe because PayPal has a lot of issues before it in the eyes of investors. We also learned today that Block was cutting jobs, the artist formerly known as Square. It has a goal to cap its workforce at 12,000 people. And so that's why it was doing its cuts. We talked earlier about UPS, which announced cuts of 12,000 workers. So in other words, it's cutting the same number of workers that Block wants to cap its workforce at, which just shows you the size of UPS. What struck me in the UPS announcement is CEO Carol Tomé said those workers are never coming back. This is not a temporary reduction. It's sort of a secular, permanent change in the way they do business, that they want to be more efficient and use technology more. But it's just interesting in the context of all of these other cuts, all of these companies just really focusing on efficiency, and not in the case of UBS, but in a lot of these cases, being rewarded by investors.
Yeah, and PayPal specifically was interesting. We always talk about the kind of idiosyncratic puts and takes. I mean, PayPal is an interesting one, and we've talked a lot about this name because you do have a new CEO, Alex Chriss, named CEO over the summer, and we've talked about how the street has actually become gradually more cautious on this name. You have seen a number of recent downgrades for different reasons, whether it's competition or pressure on profitability, but the stock is up about 4 or 5% this year, but still down about 20% over the last 12 months.
Definitely. Let's move to the oil patch, shall we? Shares of Schlumberger slipping today after Aramco, the Saudi Arabian oil company, said the Saudi government has ordered it to not ramp up its oil production capacity. Aramco said it had been working to increase its production capacity to 13 million barrels a day. Schlumberger and the other oil field services providers falling on the news. Now, why is this a big deal? Well, first of all, Saudi Aramco is huge.
It is the largest oil company on the planet.
Exactly. Yeah. Secondly, this is a big reversal for the company. It had been planning to boost capacity. Now it's planning to draw back. So there are lots of implications. Obviously, there are implications for these companies and demand for their products. And there are implications for what the Saudi kingdom believes is the long-term demand for oil, which is quite interesting.
Yeah, I mean, I thought it was a fascinating because one, as you put it, Julie, the first question is, okay, that's really interesting how the kingdom is thinking about what global oil demand looks like in the future. Also, where the kingdom is putting money to work. I mean, crude is, of course, listen, it's still foundational, obviously, the Saudi economy, but we know they've been expanding natural gas, chemicals, right, renewables. Bloomberg, by the way, citing sources, it says it's those businesses I just named likely get a share of the money saved from the oil capacity expansion. So there are a lot of different interesting threads. I would say, listen, Schlumberger got hit on this news, but a number of names did too. Halliburton I saw down, Baker Hughes as well.
Yeah, Weatherford as well. Yeah, really interesting story.
One to watch for sure. All right, let's finish it out here. Super microcomputer shares surging today. Look at that pop. That's after earnings beat on the top and bottom lines. Company also raising guidance for the full year. A couple interesting, so obviously the server maker here, they reported investors like what they saw. Q2 net sales, 3.66 billion, Julie, that was a beat. They raised their revenue estimate for the year. They now, it looks like, see fiscal year revenue between 14.3 and 14.7 billion. Big move already this year. I mean, this stock jumped not only this year, but this follows a jump about 235% in 2023.
Wow. This comment from the analysts at Barclays stood out to me. They said one of the takeaways from the call with management is that AI demand is still outstripping supply, which obviously has potential takeaways for AMD, which reports after the close today, NVIDIA, and many of the other server and semiconductor companies that are servicing this booming AI universe, if you will. So, we'll see if indeed there's the follow through. Yeah,
and other analysts were saying, Julie, I saw some notes. Yes, very strong demand with this name, no doubt. You're seeing the reaction. How much is already priced in, they were asking, is worth knowing after the kind of ramp you saw here.
Always a good question. We're just getting started here on Yahoo Finance Live. Coming up, Pfizer posting a beat on the bottom line for the fourth quarter. We've got an exclusive interview with Pfizer CEO Albert Bourla on the other side. Plus, tech giants headlining a big day of earnings. We'll be breaking down the numbers from Microsoft, Alphabet, AMD, which we just mentioned, much more later in the show, and the newest edition of our series, Goodbuy or Goodbye. We'll get analyst insight to break down 2 stocks and help you make the best choices for your portfolio. All that and more when we come back. Pfizer surprised Wall Street this morning with an unexpected profit beat in its fourth quarter. The pharmaceutical giant saw a smaller hit than expected from its declining COVID business and is ready to embark on a new chapter, reaffirming its full-year guidance for 2024. I'm very happy to be joined now by Pfizer's CEO, Albert Bourla. Albert, it's good to see you. Thank you so much for joining us.
Thank you for having me, Julie.
So, as I said, the COVID numbers beat your lowered forecast from December. Sales of some of your other products did miss expectations. It was sort of a mixed picture there. But as we go through 2024, do you think you're going to have better visibility, better predictability from your COVID-related revenue as well as revenues from other products?
I do think so, because the COVID revenues have been significantly de-risked right now. It's not only how much is going to be the utilization of the products, but it is basically that we have gone into commercial model. We have renegotiated multi-billion-dollar agreements with multiple governments in the world to resolve the stock issue. So I think people can predict the COVID business very well. But the non-COVID business also, it is the one that I think did very well in last year. We had the 7% growth. And we gave a guidance of 8 to 10% growth for the non-COVID business going forward. So we are very, very optimistic that we will make this guidance, and that's why we reaffirmed it.
And you have been laying out this vision for a post-COVID Pfizer, right? The Seagen acquisition, obviously a huge part of that, and building out that cancer franchise. But it seems like there is a bit of a disconnect between the vision and the optimism that you're expressing and what we're seeing reflected in the stock price and what we're hearing from Wall Street. What do you think accounts for that? What do you think the street is missing here?
I don't think that the street is missing something. I think the street was disappointed because we missed our initial expectations on the COVID revenues. And then they were wondering what will happen with this cost base that was quite high. So it's just waiting to see how we're going to execute going forward. So it is a show-me story. I think that we have a very, very good track record. We just mentioned that we beat EPS consensus. You know, in the last 5 years, we had 20 earning releases. In 18 of these 20 earnings, we beat Bloomberg estimates in EPS. So it's not that we are a company that is used to miss their projections or the external expectations. So we are moving into this new year with a very high confidence that all these investments that we have done, so to address the post-LOE gap that we were expecting between year 25 to 30, will give a very, very good return on investment. And the flagship of this is, of course, a Seagen acquisition that is going to position Pfizer as the leader in oncology.
You know, it's interesting when you talk about Seagen and the role that it's going to play. I was flagged to some commentary from JP Morgan today in reaction to the earnings. And one of the things they said is that the company does not have what they call a quote unquote clear anchor asset. Do you think Seagen is that clear anchor asset? And if it is, why isn't that message being received?
I think Seagen is an anchor platform. Mm-hmm. When we announced the acquisition of Seagen back in 23 early, we basically make a very big bet in two things. One, the ADC technology, and secondly, a company that we felt can excel in this technology. Since then, I feel very good for both, actually way better than when we announced. The ADC technology has become the hottest thing in M&A right now. Every company is trying to find an ADC, but you know, what is available is one product here or a product there. With Seagen, we were able to get a whole platform of 4 marketed products that they're having a very strong life cycle plan, 13 assets that were in different stages of the pipeline, and the know-how and technology that it was positioning the company as the best company of ADC. So I feel that there is an overall consensus in the market that the bet on the technology was the right one. Now coming to the company, I feel even better, because since we announced the acquisition, Seagen was able to release data that were transformational in terms of efficacy that they were able to demonstrate in very difficult to treat cancers like bladder cancer. So both company and technology is where I think we are placing our bets, and I think that will be a significant anchor for us.
Now, in addition to the enthusiasm over ADCs, as you know, the market has been sort of obsessed with the new weight loss franchises that are out there. Now, you have an experimental drug on that front, but I do wonder what you make of the hype, some would say, the obsession, some would say, over these new weight loss drugs. Do you think that that is warranted?
Look, I can't comment if the stock appreciation that is following, let's say, this obsession, as you called it, is having as a result. But I think that obesity, it is a major problem for the health of humans. I think that the GLP-1s have been proven to be very, very good medicines. And I think it's just the beginning of an era that new anti-obesity medicines will come. So I'm very optimistic about the science. And we are not having only one, we have 3 obesity assets right now in the clinic. And of course, we are working on many other which are not in the clinic yet.
When we were in Davos, I know you spoke to Barron's and you talked about investing your pension back into Pfizer stock, as another sort of sign of optimism here. Did you want that to be partially sort of a signal to investors about your confidence in the company's future?
First of all, it is a signal that I have a high confidence and I put my money where my mouth is. So I'm all in. So it was a significant investment for my financial situation. And I put it all in Pfizer because I believe it is one of the best investments that anyone can do right now. So then the investors, of course, they should make their own calls. But myself, my entire pension went in December into Pfizer stock.
Albert, finally, I want to ask you about the bigger backdrop in the world right now, because as we know, as Pfizer was developing the COVID vaccine, you forged a lot of strong relationships with world leaders. As you talk to them now, as you have different conversations, there are obviously a lot of different challenges and conflicts facing the world now. We have Russia, Ukraine, we have Israel, which is now sort of expanding into the Red Sea. We have ongoing US-China tensions. What do you think is most acute, biggest risk there, and how are you thinking about how to manage that?
There is no doubt that we are living turbulent times and the geopolitical tensions are right now at an unusual peak. But I think that world leaders, to the degree that I speak to them, they express from one hand concern about that, but also they express optimism that the world will overcome those challenges and a better future is coming. I discuss a lot science issues with a lot of these leaders, and I know that they are very optimistic about what I expect to be a scientific renaissance. I think that going forward, we are going to see in the life sciences particularly, significant advancements, not only in biology, but also in technology, AI being one of them, that will allow us to deliver meaningful solutions to patients for diseases that they didn't have a solution before. Oncology, it is clearly one of our very big bets, but the same will happen in many other areas.
Albert, I also, you talking about the promise of oncology and of science also makes me think about some recent findings that show that the rate of cancer is growing, and in particular among younger people, or younger than it used to be. What do we know scientifically about why that's happening, and how is that going to inform how we treat and even eventually, hopefully, prevent these cancers?
I'm not sure I have all the answers to that, but there is an element that, first of all, people living longer, and cancer is clearly related with the age. So as people are living longer, you have higher incidence of cancers. But as you said also, there are reports that and statistics that are demonstrating that we have now more cancer in younger people. I think it's more because we have better diagnostic tools, and then more cancers are diagnosed around the world that they were not diagnosed before. I don't know if there are other conditions that are contributing to the growth of patients with cancer, other than that. But what I know it is that right now, among all therapeutic areas, cancer is the one that I am most optimistic that science will deliver meaningful solutions. So I think it's good news for patients.
Well, let's hope that you are correct on that front. Albert Bourla, thank you so much. Really appreciate your time today.
I thank you very much.
Thanks. Stay tuned. We've got much more coming your way on Yahoo Finance. It's a big, noisy universe of stocks out there. Welcome to Goodbuy or Goodbuy. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're taking a look into the growth story of two big players in the S&P 500. I'm here with Lou Bassanese, Public Ventures President and Chief Market Strategist. And let's get to your buy stock, Lou. Thank you so much for being here.
Thanks for having me.
Let's dive right into it, right? And this is a stock we've talked a lot about as a growth story that we've seen over the last year. It's Eli Lilly, and obviously the growth is reflected in what we've seen from the stock price. But
it's
walk
about
us
80% in the last year.
Yeah, so walk us through why you still think it's a good
let me
buy
disclose.
here.
I don't know everyone's personal financial situation, so you got to do your own research on this. But I think this is one of those classic examples of a tech stock or a science stock that's in the early innings of growth. I mean, if you think back to the smartphone boom or NVIDIA last year with AI, you want to be positioned in the early stages of growth. And if we look at just the numbers, we got about 3% of the U.S. population that has a prescription to a GLP-1 weight loss drug. That's going to go to 7 to 10% very quickly. And then there's about 40% of the U.S. population that's considered obese. So you have a market that it can grow for a long period of time, which I think is why you want to get in, consider getting in when you're in the early stages of that.
Right, even after the gains that we've seen.
Right.
But it's not just the GLP-1s. Talk to me about the bigger story here.
Yeah, so I think GLP-1s is going to be the driver here. There's multifaceted momentum in that story. You're seeing people, this is one of those drugs that has visible signs that it's working, right? So it's got built-in advertising. If you're using a GLP-1, you lose weight, your friends notice, they started,
what have you been doing?
What have you been doing?
What can I do?
That leads to greater sales, that leads to greater insurance coverage. So if you look at the data for this upcoming year, last year there was about 25% of employers that covered GLP-1s. This year it's going to go to about 45%. So that's just a nice positive feedback loop that's really going to feed Eli Lilly's sales growth.
Cool. And then let's talk about the pipeline as well. For
Yeah,
Eli
I think
Lilly.
this is really important for investors to understand because there's another player in this race. That's Novo Nordisk with Ozempic and Wegovy. There's two differentiating factors, right? Mounjaro works better than Ozempic in a head-to-head comparison. So anywhere from 4 to 12 pounds greater weight loss on average. But then they also have in their pipeline a phase 2 molecule that would be a small molecule, so a pill, an oral as opposed to an injectable that could really lower the cost and then lead to greater sales and a better competitive position.
Right, that's really the next thing that people are looking for. As always, we like to ask people what the risk would be when we're looking at this. And, you know, there already have been some reports of some negative side effects for the GLP-1.
Yeah, and I think that's always the worry with any types of drugs. And if we look in the weight loss market, I don't know if you remember back in the early 90s, Fen-Phen was this miracle weight loss drug that was on the market for about 5 or 6 years before you had to pull it. CAR-Ts were all the rage when the first one was approved in 2017, and then just in the recent months, we had the FDA come out with warnings because they're causing secondary cancer. So I think that's what you have to contend with here. Could 3, 4, 5 years down the road, the FDA and the science prove out that there's some negative side effects that are just not particularly favorable, and that's really the biggest risk I see from a company-specific space.
I'm also curious, though, how much you talked about that the coverage percentages are going up, but how much are you concerned about coverage of these types of drugs? Because it has been a little slow going.
Yeah, I think that's always going to be a driver, a bureaucratic issue to get through. But the other thing you have to realize too, there's price discrepancy. So people that want these drugs are going to find ways to get them. If you look now in Mexico, a cost is about $200-300 versus over $1,000. So you're going to see the competitive forces of the market come in line, I think, because there's so much demand.
All right, so in a very different industry, let's talk about the growth stock that you are saying goodbye to here. And that's Tesla. And I have to admit here, Lou, we've had quite a few people say they do not want to get involved with Tesla as of late. So I don't know what that says, that the goodbye consensus is kind of forming around it. But let's go through your case here. Overpriced and overhyped, you say.
Look, I never want to bet against and go short against Elon Musk. I think a lot of people want to say goodbye to him. But right now, we're looking at a maturing market. This stock, by any metric, is overpriced. I mean, if you look at it, take the market cap and divide it by the number of cars that Tesla produces, it's about 300,000 per car. If you compare that to the established automakers, they're valued at about 8,000 to 32,000. So it's wildly overpriced on the fundamentals of the business, which has always been the case. But now, I mentioned here too that we're entering the maturing stage of this market, right? The growth is slowing down, and I think that's the biggest concern. Premium prices are fine when the growth is going to continue. When it starts to slow down, that's when you have to get concerned.
Well, and then that feeds into another point that you have, which is that more competitive market, which has been affecting the margins for the company.
And if there's one metric to look at in this EV market, in particular to Tesla, it's this here, because this is how you're going to be gauged. When you have stable margins, but you're going into a more mature market, it's predictable, right? You know what your profits are going to be. But as you can see here, Tesla's margins are all over the place, and in the last quarter, they got cut in half. So there's no confidence that these margins are going to be maintained as the volumes grow and leads to a profitable bottom line.
Right, and Elon Musk has definitely sort of tried to temper expectations for
The chart kind of looks like his
expansion.
personality, a little bit erratic sometimes.
And then finally, maybe that speaks to point number 3, which is that there's less investor confidence.
There really is, and on the last call, he said they were going to be they were less transparent on providing growth guidance, and investors don't like that at all. I mean, we saw that with Tim Cook at Apple when he removed a couple years ago during COVID the growth guidance. People were not happy about that. Investors will deal with uncertainty as long as you're communicating those uncertainties clearly, and that's just not what's happening here. So.
All right, as always, on the flip side, we like to look at what could go right for Tesla. And, this speaks to the AI story is really for the bulls. When you look at their long-term investing case, this is what they're pricing in. This is how they're making their valuation.
Agreed. Elon Musk likes to promise a lot. He hasn't always been on time or on budget for delivering, but if he's
done it at all,
or done it all, right?
Cases.
Fully self-driving cars. Anyone? But I think this is the risk here. I will give him credit. He is one of the best public company CEOs for casting a vision and bringing together a loyal fan base of customers and investors that buy into that and that will support him as he endeavors to make it happen.
And just quickly, we did a little disclosure at the top, but do you own Eli Lilly and are you short Tesla?
So no disclosures on that, not short,
position.
long, no firm ownership or anything. So.
Okay, good to know. All right, we are going to summarize your position here on these guys. Now, you're telling investors, buy Eli Lilly. You like the potential growth and momentum from those diabetes and weight loss drugs. On the other side, you say, avoid Tesla, overpriced, experiencing decelerated growth and lack of guidance. Yeah. Lou, thank you so much.
You summed it up better than me.
Appreciate it. That'll do it for the latest installment of Goodbuy or Goodbye. Look out for new episodes 3 times a week at 3:30 p.m. Eastern. We've got more Yahoo Finance coming after this.
This week, Yahoo Finance is taking a look at key charts from the top minds on Wall Street as part of our chart book series. And this hour, we're looking at the labor market. Here with me now, Claudia Sahm, former Fed economist and Sahm Consulting founder, and the reporter behind the Yahoo Financer chart book, the one and only Josh Schaefer. Claudia, it is great to see you and have you on the show here today, Claudia. I thought maybe to start, Claudia, you could walk our viewers through what exactly is the Sahm rule, Claudia, and what's it telling us right now about the U.S. economy?
The Sahm rule is a way to say, hey, are we in a recession or not? So it's an indicator. It doesn't forecast anything. And I am very happy to report that it is in a good place. We are not in a recession. Now, the Sahm rule, the idea of it is it looks at the national unemployment rate. That really tells us a lot about how the economy is doing. And in particular, for a recession indicator, we look for relatively small changes over time in the unemployment rate, because usually when things get going, they keep going in a bad way with the recession. And you can see with the chart, this is the Sahm rule. So it looks at the 3-month average of the unemployment rate. We smooth out the bumps and wiggles. Where are we at now versus what's the lowest over the prior year? That's what it's charting. And every time we go into a recession, it has gotten above a 0.5% percentage point and then kept going. And right now it's about 0.2 percentage point. So we are not in a recession.
And Claudia, the Sahm rule was certainly something that people like to talk about a lot, specifically maybe this fall. I think it was around November. A lot of people were highlighting, is this sort of when the uptick in unemployment comes? As you noted, it never really did come. I'm curious what dynamics you're just seeing in the labor market right now that has kept the unemployment rate so low.
We did see the unemployment rate drift up. It had been at a very low 3.5% last summer. And by the fall, by the end of the year, we were up around 3.7%. So that is higher, but a pretty small increase. What's been happening in the labor market, and you can look across all different kinds of metrics, is we had a lot of disruptions and we've been trying to rebalance, and it's happening. It's just, it takes time. Right? We have very good developments with a lot more people coming into the labor force, particularly immigrant workers. It took some time to match them up with jobs, so the unemployment rate drifted up for a little bit. But we needed those workers, so that's good. So we're still just working through a lot of disruptions, and I and everyone else is keeping an eye on that labor market to make sure that it's rebalanced and not slowing in a way that could really go downhill.
And Claudia, as you look out, across 2024, I am just interested your expectations for the labor market, Claudia. What do you think the kind of trajectory looks like there?
It's good. The outlook is good. And for the past 2 years, I have said repeatedly that a soft landing, meaning we get inflation back to 2% and we keep unemployment low, it is entirely possible. That's been my base case. And we can see the landing. Right? I mean, we are getting so close to this. And an absolute key part of this has been a strong labor market. And with that, American consumers out there spending.
Claudia, how big of a role does the Fed's path play in that? Because I'd imagine if the Fed were to keep rates for a little bit higher here, maybe longer than some expect, maybe not, they don't cut in May, they don't cut in March, or they don't cut in May. At some point, is that going to have an impact on what we're seeing in the labor market?
It's highly likely. I mean, it should. The Federal Reserve is putting a lot of pressure on the economy, and interest rates are legitimately high relative to where they were before the pandemic, and probably where they should be when things are just neutral and the Fed isn't doing anything. So the labor market's strong, the consumers are strong, but that doesn't mean it stays that way. And I mean, the Fed has said they're going to start cutting. They're kind of dragging their feet, but they're going to do the right thing in the end. It's just we need everything to hold together to get back to that fully rebalanced place, and that involves the Fed being back with lower interest rates.
So, Claudia, with that in mind, I mean, what are you listening for in Chair Powell's press conference tomorrow, and maybe even in subsequent comments from the Fed moving forward?
My biggest goal for tomorrow is to go in and really fight my confirmation bias. And I think everybody should, because the Fed and Jay Powell at the press conference will be very cagey and very vague, and we'll all have a tendency to go hear what we want to hear. I certainly think they should be cutting. I do not expect them to be cutting until May. And so I got to really listen to what he's saying. They're going to open a lot of doors in terms of when they'll cut, but they're going to signal very strongly, as have Fed officials speaking in recent weeks. They're going to be cautious. They really, really need to see a lot with inflation. So I don't think people who are thinking thinking March and it's soon, I think they might be disappointed tomorrow if they really listen closely to what Jay has to say.
All right, we'll all be listening closely to what Jay has to say. Claudia, thank you so much for joining us today, and our thanks again to our own Josh Schaefer as well.
F5 topping estimates on the top and bottom line for the first quarter. The multi-cloud application services company seeing earnings growth despite a dip in revenue from a year ago. And while customers continue to watch their budgets, F5 sees encouraging signs of stabilizing demand trends. Here to discuss this and more is Francois Locoh-Donouvre, F5 Chief Executive Officer and President. Francois, it is great to see you again. Thanks so much for joining us. Talk to me about the stabilizing demand. Talk me through what you are seeing from customers and their willingness to spend.
Julie, I think last year we were seeing a lot of customers that were canceling projects or delaying projects because they were surprised, sometimes in the middle of a project that their budget would go away. We have not been seeing that over the last 6 months, and specifically over the last 3 months, we have seen more predictability and more stability with large enterprise customers around the globe. We've seen that both in the U.S. and outside of the U.S., where customers are clear on their budgets going in, and they move forward with the projects that they have planned. So it gives us a little more visibility and stability in the business.
And Francois, I know in that earnings print, and it's great to see you and have you on the show again. I know the Street, Francois, was impressed by the strength in profitability. EPS came in ahead of consensus. How confident can you be, Francois, that kind of continues here over the next few quarters?
Well, thank you, Josh. Yes, we did deliver revenue at the top end of our range and earnings per share growth well above our guidance range. And so, we're confident that we're going to be able to execute over the next few quarters based on the stability and the predictability we're seeing on the market. But beyond that, Josh, there's a broader trend in the market, which is that today, businesses are run by apps and APIs. And there was this idea a few years ago that all applications, that large enterprise would move all of their applications to a single cloud. And that idea is pretty much dead today. The reality is large enterprises, to deliver the digital experiences that we all enjoy, large enterprises are moving their applications across multiple clouds. Today, 90% of organizations actually deploy their applications in multiple public clouds, in data centers, and on edge sites. And that's great from a flexibility perspective, but it has created a crisis for securing all these applications and all these APIs. And F5 has built a portfolio now that is unique in its ability to secure all applications regardless of where they're at. And so we think that position and the trends in the market for the explosion of apps, explosion of APIs, is going to give us a very strong mid to long-term opportunity to grow the business.
And Francois, how much has generative AI been a factor in that change that you're talking about with these various application-driven clouds?
Julie, generative AI is going to play a very important role because generative AI is an accelerator of what I just described. So, I just said that the world is run by apps and APIs today. And we are going to, and AIs are going to be modern applications that themselves are going to be highly distributed. So, AI workloads are going to make heavy use of APIs. They are going to live in multiple public clouds. And the needs for security, specifically securing these apps, securing these APIs, are going to be significantly accelerated by generative AI. And this is something we're going to see play out over the next several quarters and even over the next several years.
And Francois, has AI, changed or impacted the way you at F5 think about hiring and spending?
It hasn't impacted how we think about hiring today, but it is impacted how we think about spending because we have started across multiple functions at F5. We have started testing and experimenting large language models in areas where we can increase productivity. And so we're looking at that for software development and accelerating productivity in software development. We're looking at that for support and for our sales and marketing efforts. I think at this point in time, I think large enterprises are all going through the learning curve. We are going through the learning curve pretty quickly. So I would expect that we start seeing these things in production more in the 2025 timeframe and beyond.
And Francois, something I have been wondering amongst, the enterprise-reliant companies like yourselves, as we see this AI spending cycle, is there any concern because of the huge investments in AI that other places will not be getting the attention that they need?
It is likely that other categories of spend for large enterprises could suffer from the focus and the spend on AI. F5, we are pretty confident about where the spend is going to go because we are an enabler of AI as a company. If you think about all these AI workloads and large language models that are going to be deployed, they're going to need more traffic management capacity, and they're going to need more security. Security is a huge issue for AI, and we have positioned ourselves to have unique value proposition to really secure all these AI workloads across all cloud environments. And therefore, we think from a category spend perspective, over time, we should be a beneficiary of investment in AI.
And Francois, I also want to get your take on kind of the broader competitive landscape. It's an issue you touched on, during the call, Francois. You talked about how a few of your rivals have now gone through this kind of change of control, as you said. Maybe just kind of walk us through how the landscape is shifting.
The landscape is changing. In our traditional application delivery market, we have had a couple of competitors, both in hardware and software, that have had a change of control, and their customer playbook has changed materially. And that contrasts with F5. We have been investing in this category for many years, and we're just now releasing next generation hardware and software that's very exciting to our customers because it brings the benefits of the public cloud to their on-prem, their data center environment. And so we're seeing a contrasting approach from us versus competitors that we think will benefit over time. And then in the areas of security specifically, we have been really focused, Josh, on securing applications and APIs. We have competitors that look at a lot of areas of security, but we are absolutely focused on apps and APIs because we think that is where the value is, and we think that AI will accelerate the needs for more apps and APIs, and that's where we are focusing our competitor attention, and hopefully we'll continue to deliver value for customers in these areas.
Francois, it is always great to have you on the show, talk about F5's earnings and what's ahead. Thank you so much, as always, for your time.
Thank you so much.
Coming up, closing bell on Wall Street, we're checking in on the latest market moves, the top trending tickers, and getting you set for a big hour of earnings. Stay tuned. More Yahoo Finance still to come.
closing bell on Wall Street right there. So let's do a check of the market. So we did end up, it looks like, with the S&P 500 just slipping into the red, not making another record close today unless things kind of settle out in another direction. But the Dow did make it, well, up about 134 points, or about 1/3% on the session. The Nasdaq falling down 0.75% as we await. Forget about last session. We're looking ahead because we're minutes away now from breaking earnings reports from Microsoft, from Alphabet, from AMD. And as we know, there is so much excitement and importance, Josh, being put on these earnings because they've accounted for so much of the rally this year and because they're going to account for a lot of earnings growth. At least that's what investors are looking for.
Yeah, and also interesting the runs they've had, Julie. I mean, if we pull back the charts and you were looking, since early November, the runs have been impressive. I mean, Microsoft since early November is up about 20%. Alphabet is up about 20%. AMD is up about 60%, right? Wow. So they have had strong runs into these prints. How much good news has that kind of priced in at these levels? We'll find out.
Yeah, we will find out. And there's also going to be a lot of questions about AI and whether these companies are monetizing it yet. But as we await these numbers and start to go through them, we're going to turn it over to our Jared Blickery. Markets closing the day mixed, as I mentioned. The S&P 500 pulling back from its record high. Jared Blickery, give us the recap.
All right, well, we got a record high for the Dow, and as you can see, the other two majors, plus the Russell 2000 in the red for the day. Notably, the Russell 2000 off about 0.9%. And when we look at the sector action, mainly about values thrown in, we got a few defensives and also a couple of cyclicals. But financial and energy, those stocks ruled the day, each up about 1%, staples up 0.5%, materials just behind it, healthcare and industrials also in the green, and real estate was the worst performing. And notably, the mega cap sectors, which have really outperformed recently, taking a back seat today. Tech, communication services, consumer discretionary, all in the red, but nothing down by more than 1%. And here's what the Nasdaq 100 looks like. NVIDIA, another record high, go figure, but not so for the other mega caps. And Tesla's still a mega cap, even though it's on this side of the board now, up 1/3%, clawing back some of those year-to-date losses. Apple down about 2%, Meta down 0.25%, and Microsoft waiting for those earnings down 0.25%. And let's take a look at some of the leaders here. More red than green. In fact, one of the few things that was working today was oil. I mentioned oil up, and PSCE is that smaller small cap oil ETF. That was up over 2%. Crypto, specifically Bitcoin, seeing some green here. Value stocks, home builders. But to the downside, ARC components. The disruption trade not working today, down 2.5%. IPOs, Chinese stocks, solar, and chip stocks. So not just chip stocks, a cyclical part of the tech sector, but really the fringier part, the disruption part, that ended in the red as well. And aside from Tesla, you can see lots of dark red on the screen as well. Roblox down 5%, guys.
Jared, thank you very much. All right, let's get to breaking earnings news now. We've got Microsoft coming out with its numbers in the last few moments here. The company's second quarter revenue coming in at $62 billion. That is ahead of the $61.1 billion that analysts had been anticipating here. And looking at earnings per share of $2.93 to 78 is what analysts had been anticipating. And if you look at the various segments here, intelligent cloud revenue ahead of estimates, productivity revenue ahead of estimates, more personal computing revenue ahead of estimates. The company doesn't provide guidance in its statement. We have to wait for the call for that. Interesting to see the shares pulling back a little bit. Also, what caught my eye here was the commentary from Satya Nadella in this statement. He says, we have moved from talking about AI to applying AI at scale. By infusing AI across every layer of our tech stack, we're winning new customers and helping drive new benefits and productivity gains across every sector. I mean, I can't wait for the AI word count in the conference call when he says it 3 times in his brief statement in the earnings release, yeah. Josh.
Well, I mean, listen, when you look at that stock and the kind of monster run it has had, of course, it is so much about the AI story. It is the way that Nadella and CFO Amy Hood, the way they have focused on integrating AI across products and services. And the question investors and financialists have been trying to figure out is, okay, how much does that now, kind of pad, Julie, the top and bottom line in the quarters and years ahead? Azure will also be in focus, of course. The question there is, what do you see ahead? What kind of acceleration do you think you could look for in the quarters ahead? Other kind of points I'm going to listen to, and the conference call is key here, as you noted, we don't get guidance until the call. CFO Amy Hood, usually around 6 p.m. Eastern, that's when she gives the forecast. And obviously that could play a big role in moving the stock. But what does she have to say also, not just about AI and Azure, I'm interested in what she has to say about the PC market. Really important. There's a big debate about what that market looks like in 2024. Also gaming, smaller part of the business, but they acquired Activision.
Yes,
How excited should Microsoft investors be about that?
Yeah, if you look at the increase that we saw overall in Microsoft Cloud revenue specifically, that was up 24%. That was really the big growth driver in terms of percentage gains for revenue here. If you look across other types of areas, Office commercial products and cloud services revenue up 15%, server products and cloud services revenue up 22%, one of the bigger places. But again, I'm really curious, where exactly did they see Copilot feed into some of that revenue and feed some of that demand, as well as some of the demand for Azure, et cetera? So we have been seeing the shares pull back a little bit in the early going. Obviously, we'll wait for the forecast to see if that's validated. And we'll be also getting some analyst reaction to this in just a few moments.
All right, and we move on here. We got Alphabet earnings as well, another big name. Those shares are down in the after hours. Remember, nice run into this print, Julie. The stock was up about 10% this year, more than 50% in the last 12 months. Initial reaction, we're down here. EPS 164, that's a beat. The street was closer to 159. Revenue 86.31 billion, also a beat. Street was at closer to 85.36 billion. Cloud is interesting because remember that disappointed last time reported, but this time 9.19 billion, that's also a beat. But some interesting questions here. There's obviously the move here in part was this kind of general, more positive, optimistic outlook about the general kind of advertising environment in 2024. I think you'll be looking for more questions about the cloud business as well and what they see ahead.
Did you say the ad revenue number already?
I did not.
Okay, so ad revenue here at $65.5 billion, 65.8 is what analysts were looking for. And to your point, there was a lot of attention on that, and from what I was seeing from a lot of the previews, a lot of optimism around ad spending. So the fact that that number missed, and obviously that number is a big number for the company. That's the biggest source of its revenue. So that is something that I think people are paying attention to here, that miss in the ad revenue, perhaps one of the things responsible for that quick drop that we are seeing in the shares.
Yeah, and AI is a very listen, that'll be in focus again. It's a bit different than Microsoft in that when you talk about AI, and we're about to, going to speak to some smart financial analysts, the question is kind of like, all right, what's the contribution like, right? With Google, I think it's a way more sort of interesting conversation about, as AI develops, how much does that kind of upend and redefine traditional search?
Yes.
And what that kind of means for Google?
Most definitely. And what's that going to do to their advertising revenue as a result of that? Sundar Pichai, his statement here in the earnings release, he says, we're pleased with the ongoing strength in search and the growing contribution from YouTube and cloud. Each of these, kind of to your point, is already benefiting from our AI investments and innovation. As we enter the Gemini era, he says the best is yet to come, Gemini, their generative AI offering. Although he only said AI once in his sentence.
Just wait for the conference call,
Satya
Julie.
said it 3 times, so I don't think we can read anything into that. But it is, obviously, AI is going to be a very large part of the discussion. Initial first blush, as we look at the drop here, there was so much hope. And sometimes these companies do come out and surpass those expectations. But at least at first blush here, it doesn't look like that Alphabet has in particular with that 4% drop.
Yeah, we'll see. Also, it'll be interesting. Another question, there's going to be some changes in the C-suite at this company. Ruth Porat, remember, she already announced, obviously a well-respected CFO, who's going to be the replacement. There are some analysts, Julie, who see that as a potential catalyst ahead when they finally name that CFO.
Right, we'll be watching to see if there are any indications that we end up getting about who.
For sure. For sure. All right, we are just getting started with your earnings coverage this afternoon. On the other side, we're joined by an analyst to break down the reports from Alphabet and Microsoft, plus the latest numbers for AMD, Starbucks, and Hawaiian Airlines. More Yahoo Finance after this. We're watching big tech results, both Microsoft and Alphabet reporting moments ago. Joining us now, Ted Mortensen, Bayer Technology Desk Sector Strategist. Ted, let's start with Alphabet here. The initial reaction, Ted, investors seem a bit disappointed. They got the stock down about 4% in the after hours. Give me your response, Ted. What'd you make of the print?
Well, first of all, these are essentially for both Microsoft and Google somewhat inline expectations. And I think the amount of run that a lot of these stocks have had since November really pointed that a lot of these names, especially the cloud titans, had to see a top line beat. So if you look at Google, for example, search basically came in line. People were looking for, I think, a little bit better than that. The positive, I think, is GCP, where they returned to growth at about a 25% clip versus a disappointing report last quarter.
When we look at the ad sales number, which seems to be also maybe a little bit of a source of disappointment, what were you expecting on the ad front? I mean, I was seeing a lot of positive chatter about relatively strong spending there.
We were roughly pretty close to the street at a total advertising of 65.8. Again, the street was looking for a little bit better. It's still a relatively solid result. And if you look at search at 48 billion, that really came in line. And that's where, from a longer term perspective, people are really focused on this move to generative AI in relationship to not only some of the private companies that are 2 or 3 years out, but also Microsoft moving with the generative AI place into search. So that seems to be a very big focus longer term for the street, where Google has had basically a monopoly on search. With generative AI, you've got different players at least trying to dethrone them in some way.
Yeah, I mean, I'm interested to get your take on that, Ted. I was talking to Julie about that as well, just how you think about AI and how it could very well potentially upend, kind of redefine Google's bread and butter, which is search.
It will over the next 2 to 3 years, but this is nothing instantaneous. And I think when we see the Meta results and the Google results, they're still of the two dominant players in advertising. They will be for the next quarters to come. Obviously, Microsoft with their investment with OpenAI, the search landscape will change. There's some private companies like Perplexity that has gotten some good press lately. Over time, you may see additional competition. There's others that also could move into this group, like even an Apple or an Amazon or a TikTok, as they get scale on that data layer.
Ted, I'm looking also at YouTube revenue here. It looks like rising to 9.2 million in the fourth quarter from about, call it a little under 8 million a year earlier. It's sort of a fascinating asset for Google. Where do you think they develop it from here? Does AI feed into that? And at some point, do we see a Google that separates YouTube?
That's a really good question. I don't think anybody really knows at this point, but the 9.2 is a very solid result. Obviously, I think Google TV is taking share from some other players, whether it be direct TV streaming, et cetera. It's a good offering. It's tied to the Google infrastructure, and quite frankly, from a technology standpoint, it works extremely well. So, but as they gain subs and add content and gain that data, it is an arrow in their quiver, quite frankly, on growth that cannot be underestimated.
Ted, final question about Alphabet. It had a nice run into this print, Ted, I think in part because there was kind of this general optimism, Ted, about the advertising environment in 2024. Do you share that optimism about the ad market?
I do. I mean, our checks have been pretty constructive. I think through the tail end of the rest of the 2/3 of earnings, you're going to see generally advertising budgets being solid, and then you move into a year of 2025, not only with political spend, or 24 with political spend, but our checks have been relatively constructive on the ad spend, and I think that we'll see some very good results out of Meta when they report.
Interesting. All right, let's turn it on over to Microsoft for a moment here. And it looks like, by the way, the shares have actually turned higher in after-hours trading, I believe, after an initial kind of dip here. The company, as far as we could tell, beating on most of the metrics here. And also, as I kind of pointed out a little bit tongue-in-cheek, Satya Nadella, the CEO, saying AI 3 times in his sentence in the release here. The share is actually little change right now. So let's call it bouncing between gains and losses. So what's your sort of high-level takeaway here when we look at Microsoft?
Well, if you look at most of their results, they're in line. I think the standout is the Azure growth. They don't break in. They're hosting essentially all the OpenAI infrastructure. So a 28% constant currency when they guided to 26 to 27 is pretty powerful. And as you look at their, and this is why we have to listen to the call and also the guide, the street's very, very focused on how Satya and the team monetize generative AI from an ASP perspective. That's into Office, that's into all their Copilot offerings, whether it be on the developer side, whether it also be on Office 365. Their whole product line is being AI enabled. So the million-dollar question is some of the metrics that we'll get if enterprises are willing to pay an additional fee per seat to get that AI functionality. I think it's just a matter of time. It's not a matter of if.
And Ted, another, of course, very important variable for Microsoft is the PC market in 2024. I know that's a source of some debate on the street, what the trajectory of that market looks like. You know, what would the more positive PC cycle mean for Microsoft, Ted?
Well, listen, we're going into when you put the Gen AI infrastructure into place, and we're doing it right now. I mean, you looked at results like last night with SMCI just absolutely annihilating the number on servers. But as you go forward, we're going to have to upgrade not only handsets but the PC, and we're going to start hearing this term of generative IoT devices, and that essentially in the 25-26 timeframe, you're going to have to see most of PCs being upgraded to have Gen AI functionality. And what that means is you're going to have a combination of GPUs, CPUs, and other accelerators on that next generation PC, where that actual what's called smaller language models, or SLMs, will execute, and they'll execute on the device. So Microsoft is in the pole position to leverage, not only through Azure, but that the Gen AI PC cycle, where every PC in the world eventually will have to be upgraded. And then on the handset side, that's no different. And that's where names like Qualcomm come into space, and we'll see their report tomorrow. But we're moving to a Gen AI IoT environment, and the architectures are changing. And a lot of these large cap companies are extremely well positioned to leverage their R&D and free cash flow to make it happen.
And Ted, I'll get you out of here on this. Final question about Microsoft is that gaming business. And I know, Ted, relatively smaller part of the overall business, but of course, Satya Nadella made that big acquisition for Activision. How excited, Ted, do you think, Microsoft investors listening right now should be about that gaming business?
Well, they've got huge scale from a cloud perspective. And I think also from a synergy standpoint, the amount of OpEx they can take out of Activision, is relatively massive. And so when you put it on Azure's infrastructure and look at where gaming is going, I don't think we'll see many console cycles left. And as it transitions to the cloud, again, this is another arrow in Microsoft's quiver that could conceivably not only increase free cash flow meaningfully, but also be additive to operating margin as they get scale, and put the combined entity in more of a next generation OpEx footing.
Ted Mortensen, thank you so much for that quick reaction there to those big earnings. Appreciate it.
All right, thank you.
Let's also talk about AMD, which is just out, the chip-making giant. Initially, we saw the shares fall because of the company's forecast. First quarter revenue, says AMD, is going to be $5.1 to $5.7 billion. Analysts had been looking for $5.77 billion. But as you can see, the shares are now rising, up 1.1% here. If you look at the fourth quarter numbers, they did beat estimates. Fourth quarter revenue of $6.2 billion, ahead of what the street had been looking for. Fourth quarter earnings per share in line with estimates. The company does say that first quarter gross margin is going to be about 52%, which is a little bit better, you could say, than what analysts had been anticipating. But I have to say I'm not quite sure why we saw the stock fall. It made more sense for the stock to fall with that forecast, but now we're seeing it bounce back.
And the context here, again, Julie, I'm starting to sound like a broken record here. But again, the ramp into this print, this stock was up, I mean, year to date, it was already up about 20% heading into this report. It was up more than 140% over the past 12 months. I think some big questions, like, again, AI is going to be huge. Remember, CEO Lisa Su had forecast $2 billion in sales of AI chips in 2024, and I know some on the street thought that was kind of conservative. It'll be just, they thought there actually might be some upside there. So does Lisa Su kind of give an update there? Will be really interesting. Kind of talking more about the AI competition. What does she think her advantages are in that fight with NVIDIA? Outlook for the PC market in 2024, critical, what that means for AMD, and of course the traditional data center business as well.
I really hope that our viewers are not playing a drinking game with us every time we say ramp or AI. They would be in serious trouble here today. But I'm going to read something that Lisa Su said in the statement here, Chair and CEO of AMD. Demand for our high-performance data center product portfolio continues to accelerate. I think that's a key word here, accelerate, positioning us well to deliver strong annual growth is what is an incredibly exciting time as AI reshapes virtually every part of the computing market. So that's her commentary there. We will see what kind of commentary, speaking of which, we get on the call here, given that first quarter sales forecast is a little lackluster, but the margin forecast looks a little bit better. So hopefully we'll get a little bit of clarity on exactly what that is from here. The company did see big double-digit growth in a lot of its various sectors here. Data center segment revenue up 38%. Client segment revenue up 62%. Gaming segment revenue, though, down 17%. So that's an area that probably bears watching here.
Yeah, I mean, we talk about AI, we talk about PC, traditional data center, but also gaming for sure. What is Lisa Su about her expectations kind of for that part of the business in 2024?
Well, guess what? We're going to keep talking about AMD as we watch those shares turn higher here. The top revenue estimates for the fourth quarter. We're going to be joined by an analyst on the other side to dive more deeply into those numbers. Stick around. Shares of AMD, well, it's a moment-by-moment situation here. The shares were slightly higher. Now they're dipping lower by about 2/3, but really they've been bouncing around here. This is after the company topped revenue estimates in its fourth quarter. Its earnings per share were in line, but the forecast for the current quarter came in lower than estimated by analysts. Here to break down the numbers further, Jim Kelleher, Argus Director of Research. Jim, I can't figure out what to make of more the numbers, but really the stock reaction as well. It seemed to me that it would have gotten punished for this forecast miss, and yet it's not necessarily. What do you think?
Hi, Julie, and good afternoon. All the things you talked about before with Josh are in play here. Certainly the fact the stock's up 20% year to date and 140% year to date may tempt some investors to take profits on the lackluster guidance. On the other hand, it's kind of hard to jump off that winner or get out of the way of that freight train because the stock seems to be doing so well.
But Jim, when you look at this forecast, let me just ask you, you're an AMD bull. Does it get you any concern when you see a forecast like that, Jim, about just AMD's bread and butter markets, PC, servers, game consoles?
So it's really a tale of two forecasts. I think the data center business really surprised on the upside in the current quarter. Grew a little more sharply than I expected, and the client business did great. It didn't do quite as well as I thought. But both gaming and embedded were down. Now, gaming, no surprise. I mean, PlayStation 5, Microsoft Xbox, current iteration, they're very long in the tooth, and you probably need a combination of a new console, a new series of consoles, and also maybe a little more favorable interest rate and inflation environment to get consumers buying again. Now, the embedded business, what we're seeing, that business is sensitive to non-technology markets, and we've seen a kind of rippling weakness that, originally was in consumer devices, ripple into the industrial and automotive sector served by embedded. Both embedded and gaming, I have them down significantly on a sequential basis, on an annual basis in 1Q. But we'll probably still see continued strength in gaming and continued strength in client. And, there have been share gains in both markets over the years. So, yes, a mixed message on the guide, but part of it does reflect the macroeconomy outside of the technology economy.
Well, it was interesting because something sort of similar happened last quarter where the numbers in the forecast weren't that impressive, but it was more the commentary around the trajectory of the company. Do you think that's still kind of what's going on? And at what point is AMD going to have to actually put up some numbers that will meet all these lofty expectations?
Well, what I think is important, again, recovery in embedded and gaming is not really what investors are looking at very hard. 2023 was kind of the vaporware year in AI for AMD. They introduced the Instinct accelerators. They at the end of the year, they introduced the 8040 series of Ryzen mobile processors, and echoing what your prior guest had to say, on-device AI is a really, really big mover. He mentioned it in terms of Qualcomm. This means that companies like Qualcomm, Apple with the Bionic processor, Intel with their new Core series, and now AMD are really focused on this, having a neural processing unit right on the and GPU multi-cores, right on the processor. So that's going to be a big thing. On-device AI is probably going to be a very big thing this year.
And Jim,
but basically also getting that accelerator to get to what Dr. Su's target of $2 billion in data center revenue this year. That's going to be the big hurdle, and that's going to be the real proving ground for the stock this year.
I wanted to ask you about just that point, Jim. Lisa Su giving you that forecast, $2 billion in sales of AI chips in 2024. So I know some of your colleagues on the street, Jim, they thought that was perhaps conservative. What's your sense? Do you think that's conservative? Do you think there's upside there?
Well, think about it. This was a sub $2 stock in 2015. It's a $180 stock the other day. They've been fighting two dragons. They, took a lot of share in the x86 CPU space from Intel, although Intel was kind of asleep at the switch during a lot of that. There's no way you can say that NVIDIA is not aware of AMD as a competitor here, so it'll be a tough fight. But because of their expertise in the GPU space and, the Radeon, successor Radeon gaming technology, and that gives them a leg up over many, many other companies as they try to push into this, GPU compute. an AI acceleration space. So I wouldn't count them out. It's really difficult to gauge the market. Everything we've heard so far, to me, hinges on the ability for cloud service providers to deliver AI as a service. So it's a bit of a symbiotic growth phase, but right now the demand for enterprises is through the roof for AI enabling chips. So we'll see how it goes. But I don't think I think I'll hedge my bet on saying whether 2 billion is a realistic target or not. We'll see how it plays out in the early days. But there are very few companies that can go into this space and go toe-to-toe with NVIDIA, and AMD is one of them.
Well, speaking of targets, it's my understanding you have a $170 price target. That's where it is. And as you said, the shares were recently at $180. Are you going to, so what's going to give here? Is it fully valued where it is, or do you have to increase the price target?
So we'll have our note out tomorrow, and it'll be on all the platforms, including Yahoo Finance Professional.
Excellent.
And then you'll see our targets, our earnings estimates, our rating, et cetera. But I would say that the fact that they're succeeding in core markets and particularly regaining momentum in data center after something like 1% growth in the third quarter, shooting up to 40-something% growth in data center in this year-end quarter, and then predicting sequential momentum. That's what investors are looking for. That's really where the focus is right now. Client is important too, because that's a big moneymaker for them. So those parts of the business seem to be working well.
All right, Jim, thank you so much for joining us today. Really appreciate that time and insight on all things AMD.
Great. Josh, Julie, have a great evening.
You too. Meanwhile, Starbucks out with a disappointing set of earnings for the first quarter, yet the stock, you can see, moving higher in the after hours, up more than 3%. Our own Brooke DePalma is here breaking down the numbers. Brooke.
Good afternoon, Josh. Good afternoon, Julie. I mean, Starbucks really here, the market reaction seems to suggest that it's actually, analysts expected worse than what we got. So the market rallying here after hours. CEO Lakshman Narasimhan laying out the land, acknowledging that the coffee giant did experience unexpected headwinds this past quarter. But of course, he does believe that the brand's positioning is still very strong. Now, the coffee giant did post a miss on both the top and bottom line. Revenue did grow here 8% to $9.4 billion, lower than analyst expectations. Adjusted earnings per share also grew 20% year over year to 90 cents. Once again, also lower than analyst expectations. But if you take a closer look here in the U.S., the coffee giant seemed to have been off to a good start in October, but then was hit with the impact of union walkouts, softer foot traffic, and less visits during the afternoon. Sales grew up 5%. Once again, less than Wall Street expected. Check size also up 4%. Now, this increase goes to show that Starbucks still seems to have a leg up against competition here in the U.S. They once again are showing sales growth here in the U.S., but consumers didn't seem to completely move away after the company did take those higher prices a year ago.
Interesting. Okay, so that's what's going on here in the U.S. What about what's going on internationally?
Yeah, internationally, of course, Starbucks looking to double down, build roughly 55,000 stores by 2030. And one of those markets where it's making the most ambitious goals is in China. You did see sales increase in both internationally in China. Yet again, less than Wall Street expected. But in that second biggest market, which is China, both China and the U.S. make up roughly 61% of Starbucks' portfolio. You did see a slower recovery yet again as the country lapsed those COVID-19 restrictions. Foot traffic there was up 21% year over year. But the check size in China did drop 9% year over year. What we're really seeing there is a story of growing competition in China. They are seeing Luckin Coffee as well as Conti Coffee, both brands there, come in with really aggressive low price strategy, and Starbucks really looking to compete in that space.
All of that, so it's a little confusing why the stock is up.
Yeah, I mean, Wall
misses.
Street did expect, not a huge increase in sales growth. They didn't expect too good of a report here. And so these prices coming in worse than expected, but yet they had expected not major results here.
Interesting.
More to come on the call for sure.
Yeah, definitely. That's going to be interesting. Brooke, thank you so much. All right, coming up, it wasn't just big tech reporting, or Starbucks for that matter. We've got the rundown, the numbers from Match Group and Hawaiian Airlines as well on the other side. Stick around.
Frappuccinos, lattes, cold brews, refreshers, and much more. With over 35,000 stores in 80 different countries, Starbucks has created this perception of being an affordable luxury for the past 40 years. In 2023 alone, the coffee chain generated almost $36 billion in revenue. But what are some of the achievements that led to such success? Beyond the Ticker takes a deep dive into the company's history. Starbucks was founded in 1971 by Jerry Baldwin, Zev Ziegel, and Gordon Bowker at Seattle's Pike Place Market. The first Starbucks store was located in Seattle at 2000 Western Avenue from 1971 to 1976. Then it moved to its first official location, 1912 Pike Place. In 1987, the three founders were ready to sell the Starbucks brand. That's when Howard Schultz, who was actually their former head of marketing, returned to acquire the company after he had left to create his own booming cafe business, Il Giornale. Fast forward to June 1992, Schultz took the company public with a portfolio of 140 stores, a revenue of $73.5 million, and a market value of $271 million. By September 1992, Starbucks' share price jumped nearly 40% since its IPO. In 2003, Starbucks acquired its hometown rival coffee business, Seattle's Best Coffee and Torrefazione Italia, from AFC Enterprises for $72 million to help expand its footprint. But the business wasn't always buzzing. 5 years later, Starbucks faced its weakest quarter as a public company, as U.S. consumers pulled back amid economic troubles, leading to the closure of 600 underperforming stores and cutting back U.S. expansion plans. In March 2020, Starbucks closed cafe-only stores in the U.S. for 2 weeks due to the COVID-19 pandemic. COVID-19 lockdowns caused Starbucks to suffer a general 10% sales decrease and a 50% decline in sales in China. In October 2022, Starbucks named Lakshman Narasimhan as interim CEO before he took over the helm from Schultz in late March 2023, marking the end of Schultz's third and what is expected to be his final tenure as CEO. And so, from a single store to the international coffee powerhouse that it is today, with innovation at its core, the momentum is there as Starbucks aims to ramp up its locations internationally.
In case you hadn't noticed, earnings season's in full swing with a jam-packed list of companies reporting quarterly results. Here with the latest numbers hitting the wire, we've got team coverage. Yahoo Finance's Pras Subramanian, Alexander Canal, and Josh Schaefer. Pras, let's start with what you're eyeing in after-hours trading.
Yeah, sure. I'm watching shares of Hawaiian Holdings, Hawaiian Airlines, which is set to merge with Alaska. Reported top-line revenue of $669 million versus Bloomberg consensus estimates of $668.8 million, so slight beat there. That figure is down 8% compared to a year ago, however. Hawaiian reported an adjusted EPS loss of $2.37 a share versus a loss of $2.35 estimated, so slightly wider miss there. There was concern the Maui fires from last summer would impact Q4 results, but Hawaiian said it saw a steady recovery of travel there from North America. Looking ahead, the airline expects its merger with Alaska Air to close in the next 12 to 18 months. And from a guidance perspective, it sees available seat miles, or ASM, climbing 6 to 9% in 2024. Note the airline does not have exposure to the Boeing 737 MAX aircraft. Lots of earnings to swipe through here. Alexander Canal standing by with the latest from online dating giant Match Group.
Yeah, Pras, I liked your transition there, but we received a bit of a mixed bag for earnings when it comes to Match Group. Last I checked, the stock was trading relatively flat, so it's likely that we'll see some movement there on the call. But I want to start with the negative side. Total revenue per payer, otherwise known as RPP, that missed expectations in the quarter, coming in at $8.67. Although that is up 17% year over year, the estimate there was for $18.98. Another metric that we could possibly see weigh on shares is that further decline in paying users for Tinder. That fell 8% year over year in the quarter, while we saw Hinge, on the other hand, see users increase 33%. Keeping up with that positive news, we did see a beat on both revenue and earnings, with adjusted operating income also coming in higher. We've recently seen Match Group implement price hikes, which did help lift operating margins in the quarter to 42%. Moving on to guidance for the full year, the company expects margins to come in at 36%, which is higher than that estimate of 25.5%. And then if we want to take a look at some other numbers that the company is forecasting, Match Group does expect revenue for the current quarter to come in between $850 to $860 million, with adjusted operating income between $270 and $275 million. But again, we'll see what management has to say on the earnings call when it comes to that Tinder miss on subscribers, as well as that overall miss on revenue per user. I think a big question is whether or not these price hikes will have any influence on subscribers moving forward. But Valentine's Day is right around the corner, so perhaps Q1, that's the time that people will get swiping.
And Ali, I'm taking a look now, zooming out a little bit on earnings and sort of what kind of price reaction we've been seeing overall. So you see here next to me, the 5-year average for a company that beats on revenue and EPS had been about 1%. That's the price reaction we see across a 2-day span around when companies report earnings. Notably, though, this quarter been a little bit better, 1.5%. Sort of commentary on the street has been maybe the bar is lower for most companies. We've been talking about how the bar is high for those big tech companies like a Microsoft or Alphabet, which reported earlier today. But the bar's been lower for a lot of other companies. So when we see beats, we've seen pretty big stock reactions. And I want to take a look at a couple of those now. And so when you take a look here broadly at, say, Netflix, right? We know Netflix had a beat. And when you zoom out to a 5-day here, you'll be able to see a pretty big run up for Netflix there. Netflix pleasing the street and then getting rewarded heavily for it. That's a theme we've been watching. We saw that again today. You had GM report before the bell. You take a look at GM stock, up 7.8% today, up over 8% over the last 5 days. And guys, really, I think the reason we're highlighting this right now, and one thing I'm watching after hours today, headed into trading tomorrow, the biggest company in the world, as of a couple days ago, Microsoft, beat on both the top and bottom line. We take a look at the after hours action right now, and the stock was just up a little bit. We hadn't seen a big move for Microsoft yet. You can see the stock down about 1% now. But the question is, once we get into that earnings call, is a double beat enough for Microsoft when we're trading near an all-time high? Perhaps a little bit of a look at market sentiment right now for some of these highly valued stocks.
Yeah, most definitely. And, we keep going back to your chart all week, Josh, that looks at how much of the earnings growth in the S&P 500 is coming from the Magnificent Seven, or really Magnificent Six as well. And so that really raises the question of, if these guys see the stocks go down, what does that do to the rally overall?
Yeah, Julie, you have to feel like it probably puts it in question, at least a little bit from a fundamental standpoint, right? I pulled up Alphabet here, and you can see the extended number we have right now, down about 5%. We're not even all the way through that call and really gotten full explanation from them yet on why some of their numbers did miss, and the company may be growing a little bit slower than some on the street had expected. But you have to think, again, when we talk about those earnings projections, we're talking about growth, right? And if we don't get the growth we expected fully from this AI drive, perhaps that will be disappointing. But it's only Tuesday, it's tech earnings week, and we still have Apple, Amazon, Meta to hear from, and they can sort of turn that story around perhaps.
For sure, a lot of big names still on tech. Thank you to Josh, Praz, and Ali for that team coverage on a very busy earnings day. Coming up, what to watch tomorrow, we break down the stories you need to know to start your day.
Breaking news, a judge voiding Elon Musk's $56 billion pay package at Tesla. What does this mean? I see $55 billion, whatever. It was a big pay package struck down by a Delaware judge. It had been challenged in court by a shareholder who said it was excessive and that the board did not provide enough information, sort of the rationale of why it was so high. So now, back to the drawing board, apparently.
So that's what that means. The board now gets back to work, puts together a package.
Apparently so. And it also means that his net worth on paper takes a big hit here if he does not get that. If you subtract that $55 billion, I think his net worth drops to number 3 in terms of the rich people leaderboard, according to Bloomberg, which tracks this through their billionaires index. Of course, it could then go right back up again if they do come up with a new pay package and sort of provide those reasons, perhaps, that the shareholder and the court were looking for.
Yeah, meanwhile, though, the stock is sliding here in the after hours, about 2%. So now you're looking, rocky beginning to the year for Tesla. Shares now down more than 20% so far this year. You already had enough headlines about EV demand and pricing cuts, China, margins. So here we go, 2.4% now in the after hours.
I think we should keep an eye on X. You think he's going to say anything about it on there, maybe?
I would bet it's a good move that Elon Musk might just say something.
Yes.
I don't bet against it, put it that way.
That's true.
All right, let's dig into our biggest takeaways from today's big earnings. I will tell you this, Julie, we're talking off camera. Very still interested in Microsoft because we got a lot of, we know it was a beat on the top and the bottom. Azure Cloud Services up 30%, that was a beat. I thought it was CFO Amy Hood, by the way, telling reporters that Azure growth rate was boosted by 6% demand for AI services. Of course, we know that is front and center here. CEO Satya Nadella really hoping to remake Microsoft as the face of AI, and investors have rewarded that. You're down 1% here, but really, you're waiting for this guidance. Amy Hood usually gives it around 6 p.m. Eastern. That's what you're waiting for.
So we're swapping here because you were on Alphabet Watch before. I was on Microsoft Watch. The call for Alphabet is already happening, and I'm seeing some of the headlines cross. Sundar Pichai, the CEO, saying that Google is experimenting with Gemini in search. That's been one of our big questions. How's that going to affect search and the search business? He says they're using the AI model to power their ad products. But he also talks about that YouTube is a key driver of Google subscription revenue. He says Google One, by the way, has nearly 100 million subscribers. So we'll see if any of that moves the needle on the stock reaction.
Well, let's see if Sundar and Ruth on the conference call can kind of get this stock moving in the right direction.
We shall see.
All right, meanwhile, time now for what to watch Wednesday, January 31st on the earnings front. Boeing, Novo Nordisk, MasterCard, Nasdaq, and Qualcomm all reporting, continuing a very big week for earnings. Boeing looking to assure investors after the door blew off a jet mid-air earlier this month, grounded a number of commercial airplanes.
Moving on to the job market, ADP private payrolls out tomorrow. Economists expecting the number to go down from December. It'll give us more insight on the private sector ahead of Friday's full government jobs report.
And checking in on Capitol Hill, CEOs from top social media companies testifying in front of the Senate Judiciary Committee tomorrow. Senate looking to grill executives about their role in protecting children online.
And of course, looking at the Federal Reserve, the FOMC announcing a rate cut decision for January. Most anticipating no rate cut, but they're going to look for insight from Fed Chair Jay Powell. He'll, of course, be speaking tomorrow in the press conference about the decision. And maybe we'll be looking for any kind of hints. When are the cuts going to happen? At what pace will they happen? Will we get the hints? We'll have to see. We'll have full coverage at 2 p.m. Eastern. We'll be here early tomorrow, folks. But that'll do it for today's Yahoo Finance Live. Join us at 2 p.m. tomorrow for FOMC coverage. Bye.